Yeah, can you, sir, please log in now?
Now I think you can get me now.
Yes, sir.
Is the reversal side okay? Fine. My logo is coming correctly. It's not on reverse side. Background.
Background is coming, though it's extended one.
No, it's not reverse side. No, still it's coming.
Yeah,
Or you're
it's-
looking at fine.
Veggie, no, Veggie. I think you're looking okay.
Yeah.
Your background is perfect.
Okay. All right. That's okay. That's fine.
So
Yes, please.
yeah, so there is a question answers being enabled. So people will be putting up their questions into the chat in the question answer session, and the other attendees will be able to see the questions only when we answer them. So all the questions will not be visible until we mark them as answered.
Okay.
And anonymous questions will not be there. So people who will be putting the questions, the name will be appearing for them.
That's fine. How is the weather at Melbourne now?
It's hot today.
It's a bit hot today. Veggie, your screen is not visible again.
Screen?
We can only read your name.
Yeah, I just switched off the video. I will just open it. No issue.
Okay.
If you're okay, we can start with the session.
Please, you can go ahead. No issue.
Yeah. Dear members, we are here for the webinar on India's budget 2023 with special emphasis on impact and perspective from NRIs and OCI card holders. We have CA Ved Jain with us, Past President ICAI, who will be conducting. And there's some ground rules for this one. We have a question and answer session. So if you have any questions, please feel free to put on the question and answer tab. We will attend to those question and answers as we go also, and maybe after the session we may attend all the question and answer to as much as possible. So please be with us. So here we start our session with introduction to welcome CA Ved Jain ji, welcome CA Samir Manjuskar, welcome CA Vishal Chopra, and everybody in this group here. So to introduce, like we all know about CA Ved Jain ji, CA Ved Jain ji was elected as a president in the Institute of Accountant of India, the apex body of our professional chartered accountant in India for the year 2008-2009 on 5th February 2008. Academically brilliant, he is a rank holder in both CA India and CA Final, a triple bachelor degree holder. He has done his Bachelor of Science from Punjab University in 1973. He is true follower of the continuous professional education after completing chartered accountancy in 1973. For the love of the subject, he did his Bachelor of Arts in Economics in 1979. His thirst for knowledge was not still, and he completed his Law of Bachelor degree in 1980 from Delhi University. A fellow member of ICAI with more than 5 decades of standing. CA Ved Jain ji was elected as the Central Council for the first time in 2004 and thereafter in 2007. CA Ved Jain ji is a firm founder of Ved Jain and Associates and is a renowned expert on taxation matter with specialization in taxation, including transfer pricing and international taxation. Member of various expert committees, panels of taxation and corporate law constituted by Government of India, Chairman of National Council on Direct Taxes of Assocham and Apex Chamber of Commerce. He has supported various clients from the assessment to high courts. Having experience of more than 50 years in the field of taxation, he has been regular advisor to the Government of India on the provisions of direct taxes, including transfer pricing and corporate law. An avid writer, he has been regularly contributing articles to the various reputed journal and has written various books on critical matters of the taxation. So with this introduction, I welcome CA Ved Jain ji and hand over to CA Ved Jain ji.
Just give me 1 minute. Good afternoon, Melbourne, all my dear friends. It's a pleasure to be part of this program and to deliver my talk on Budget 2023. Harshvardhan has been in touch with me for the last 15 days. And he was in India to receive the award. I met me 3 days back itself on the 7th of February. I believe he's probably traveling, that's why he's not here. So I have very sweet memories of the Melbourne when I was here, and I think in 2019, just before the pandemic, in the month of November, I was there in Melbourne, and I have met you, all of you there at the, you were kind enough to host a program, some get together at the restaurant, and we interacted a lot about the activities of the ICAI chapters and all those issues. Melbourne, otherwise, as a city which brings so much glamour, so much memories, as we all Indians enjoy cricket. So the first thing which we talk about Melbourne is the Melbourne Cricket Ground, which is famously known as G, by probably in G, and it is always a treat to watch how that stadium is being maintained, how the things are going on, and the museum and a walk through that ground. The last time also in 2019, I have visited at MCG. And then, of course, January, the month when we all will look into the tennis, that's another area which Melbourne enjoys, the Australian Open, which is played there. And that's another area which is beautiful. And of course, I just before the start of the session, I asked Anandji, how is the weather? Because Melbourne is known to change the weather 4 times in a day. You can have a summer in the morning, you can have the rain in the afternoon, you can have a little bit chill and a full-blown winter in the evening. So that's the weather, how it changed. And today I have been told it is just warm at the time when we have started. Let's see how the weather will be when we finish it off on these issues. And I'm very happy to see all of you participating in a program like this and having interest in the India budget. And as we know that India's economy is a growing economy and doing what I will say very well. So everybody has an interest in there, what has happened in the budget 2023, how we look into, how we go through it. I will just try to go through some of the point, and I have tried to divide my lecture by and large into three parts. One is some economic snapshots, how Indian economy has performed, what is the projection, and how this are going to work. And then some issue relating to taxation, particularly with focus on non-residents and foreign investors. And then we talk about something which is something special between India and Australia, tax treaty, etc. Some may be relevant for you. And then, of course, as Anandji announced, that we can have some question and answer there later on. We'll try to work it out on that way. So that's the idea. As we see that this time, February 2023, and this was to be the first budget of the what we call Amrit Kaal budget. The Prime Minister had laid down a roadmap for the next 25 years. We completed 75 years of our independence on 15th August 2022. And now we are planning for the next 25 years when India will be completing 100 years in 2047. And India is looking to be the leader, economic leader, a developed nation by that time. Today, still we are counted as a developing nation. And now the focus is that how we can grow very fast and can be, if not on the top, at least on the top 3 country by 2047. We have seen our GDP, we are within the number. So this week, 1st February is the week where it was a big day and busy day for India, as we all know. The stock market cheered the budget. Analysis were coming, examining the final details of member discussion. The Indian Economic Survey came on the day before on 31st January. As we all know, it is a detailed report giving the performance during the previous year, future challenges, the way forward, and the trend in different sectors tracked as stated. It also addresses primarily the key points, reviewing the country's economic development over the past 12 months, encouraging the different development papers, etc. The Government of India in the Union Budget has also laid down a blueprint for its aspirations for India in the next 25 years. And budget is no longer an annual budget. As I said, it is not going to be an annual budget this time. It's a roadmap for the next 25 years, a framework for India's growth vision relying on the 2 core concerns, growth and welfare. And that's the issue area which we are tackling. I can just go to some slide presentation. I think that will help. Can you allow me to share screen sharing, Anandji?
Yes, sir.
Okay. Is it now clear?
Yes, sir.
Now, if we can look at this, India GDP growth is expected to be robust for financial year 23, which is ending on March at 7%. The capital investment has been increased by 33% this time for the next year 2023-24, which was for 2023 it was 7 lakh crore, and it is proposed to be 10 lakh crore in the budget for the next 23-24 census numbers. There is a strong focus on the fiscal consolidation. India to remain the fastest growing major economy in the world. Electronics export have risen nearly threefold. Labor markets have also recovered what was beyond pre-COVID levels in both urban and rural areas. Private investment in agriculture sector has increased to 9.3%, and the services sector is also expected to grow by more than 9.1% in the financial year 2023. Now, GDP growth expanded by 8.7% in financial year 2022. The projected GDP growth for the financial years is now 6.7%, and so has been the consumer price index, because inflation is also one of the factors which disturbs the growth. So you may have a growth, but in case the fiscal there is an inflation, so that growth get dampened. So it is expected that India's inflation, which is at 6.1%, will go down next year. One of the reason is a default that the US and the Europe are going to have some recession. So that may also dampen the demand and may bring down the inflation. And the government of this time, now another good news is, we being all tax consultant and etc., that there is a very impressive growth in the tax collections. I hope you would have been getting news that India's GST collection is almost 1,50,000 crore per month, which is 18 lakh crore something coming out of everywhere. So that's a very impressive growth, and India's income tax collection is also going substantially higher on that part. So this just gives a overall snapshot how Indian economy is doing. That you can just look at this. The fiscal deficit, which has gone up to 9.2% in the COVID of 2021, has been brought down in the current year to 6.7%, and next year it is going to be 6.4%. I hope we all understand that fiscal deficit creates a problem because the government raises more borrowings, and that increases the pressure on the interest on the revenue side, and it also is a cause of inflation. So India is committed to bring down the fiscal deficit to 3%. And I believe till 2019, we were well on that road when we were having to 4.7 to come down to roughly 3%. But COVID was an unprecedented year, and nobody could, I think it's a reason beyond control. So the fiscal deficit increased to 9.2%, mainly because slowdown in the commercial activities because of the lockdown. And then, of course, challenges, the expenditure has to be done to meet the people's aspiration. People who have gone out of the job, the money has to be spent. So that's why it went up to 9.2%. But this year it has been controlled to brought down to 6.7, and next year it is supposed to be 6.4. So is the inflation, as you can see the curve. I need not spend my time on this issue. The CPI, what we consumer price index, we say is now likely to be 6.8%, which has been preserved on this. There have been some issues on the foreign exchange reserves. It has been steadily rising. In 1920, it was 478 billions. Now 537 in 2021, and in 21-22 it was 607. But because of some pressure on the rupee, as you could have seen, the US dollar has been becoming stronger, with the world by and large all currencies getting poorer as compared to the US dollar. It is nothing to do with any other country. I don't think this problem in US dollar rate and the Indian rupee rate had nothing to do with the Indian economy. It is mainly because that the US economy is doing well, and that they have increased that interest rate, what we call it, and that has made people to move their money from other territories to the US back. With the result, the exchange reserves have to go down a little bit in order to control the rupee. We are still at 82 rupees around per dollar, but still good. But exchange reserve, in order to, I believe, manage the foreign exchange reserves, have gone down to 563. And the GDP growth, I have already talked about it, that we are projecting the GDP growth. And this GDP growth will be service sector 9.1%. Industrial growth is projected to be 4.1%. And agriculture is allied sector is 3.5%. So our agriculture sector growth is comparatively low. But I believe that going down the line, in my presentation, I will be talking about what has been said in this budget on agriculture and what we and India and Australia can do together. I will be focusing on that area also in the next few slides on that part also. Now, this is nothing. This is inflation just slide. I need to say this is a tax GDP ratio, which is very impressive. This is the projected tax revenue, which is good. Now, this is a slide which I believe you may just be interested in knowing it. Maybe not be direct interest, what have been the tax collection. Just look at this, that our income tax collection, how they have moved it. In the year 2014-15, this was 12.44 lakh crore. And in the current year, it is 30.43 lakh crore. And then next year, it is going to be 33.6 lakh crore. Just assume in 24-25, I'm reasonably sure it will cross 37 lakh crore. From 2014-15 to 22 or 25, Indian income tax collection is going to be 3 times what was in 2014-15. Just look at the massive growth in the Indian tax collection on that part. Now, this gives an indication how strong the Indian economy is and how people are working for it, and in how what we talk of sometime fiscal deficit, etc. All those challenges will be getting addressed on that part on this issue. If you look at this slide again on that part, the GST collection, if you look at this also, which is also going very high, and it is supposed to be 9,56,000 crore in the next year. Very impressive growth on the what we call on a tax collection. So these are the areas which I believe which gives an indication how strong Indian economy is. Now, looking to this fact, now this is an important point. India to witness a steady GDP and where we are and where we are going to be in future. Now, this is slide which gives you an idea. Now, India is presently, if you look at this, we are having $3.5 trillion economy in 2020-22. It is going to be $3.8 trillion in the year 2023, and going to 4.2, then 4.4, 4.9, and then 5.4. And when in the year 2027, we go to 5.4, our position in the world will be almost number 3. China, I believe the US will continue to be the number 1 with 30.2, China with 26.4, and India will be $5.4 trillion economy. We will be ahead than France, we will be ahead than Germany, and we will be ahead Japan, and we will be ahead of United Kingdom. So our overall GDP number will be 3 as in the comparative world. But one word of caution which we need to keep in mind, as we all understand as accountant or probably knowing economics, GDP is aggregate of the total domestic product. And since India's population will be number 1 in the world now, so this absolute number divided by the population, our per capita GDP will still be far lower as compared to per capita GDP of the advanced nations. So efforts are on by India to work in a manner where our GDP improves. Now, per capita GDP presently for the year is 1.93 lakh, which I believe in US dollars sum will convert to somewhere $2,200 per year per capita, which is, I believe, low as compared to other nations. But as India is moving forward, and as are projected that over 2035 onwards, that India's population will become static, and by 2047 we will have a reverse position going down. I'm reasonably sure the Indian GDP will be per capita GDP will improve, and the condition of living in India will get also improved. Now, having talked about the general budget, etc., these are the few things which the budget proposes about what are the vision for the Amrit Kal. The vision for the Amrit Kal is a focus on youth, focus on job creations, strong and stable macroeconomic environment. That's a vision which is being worked out on this issue. And for this, the finance minister has laid down a roadmap that Amrit Kal, we will be focusing on youth power, financial sector, green growth, unleashing the potential, infrastructure investment, and inclusive development. And in addition thereto, reaching the last mile. India had the biggest problem of reaching the last mile. Our banking outreach was so poor before 2014, I believe, before we announced the Jan Dhan scheme. It is only after the Jan Dhan scheme has been introduced. Now we have more than 46 lakh crore account, which is the last mile banking. We're trying to reach out to the last people and the rural people on that part. So important for India is that in case we are able to reach out to the last mile people, the rural and the remote, the women, the deprived, the tribal, I believe Indian economy is going to rise anything, because that ultimately are going to contribute in the growth of the economy. Many people do not know what is happening, and they do not have access to best of the facilities and otherwise. I think reaching the last mile is the agenda which gives in 25 years next year. And now these are the areas which have been chosen specifically by the finance minister, that what should be done. It is agriculture and cooperative. And what we are going to do in agriculture and cooperative is this: building digital public infrastructure, which will be inclusive and informative solution. There's a very important development whereby the finance minister has proposed to setting up an agriculture accelerator fund for encouraging innovative startup in rural areas. Meaning thereby that we want that there can be startup has been in other areas, consumer oriented, but not agriculture. So accelerator fund is going to be there. Similarly, there is going to be horticulture clean plant program also, making India global hub for milestone also, setting up of widely available storage capacity, targeted funding, etc. All these are part of the budget on this issue. On health side also, there's a proposal for nursing colleges, setting pharmaceutical targeted funding for their project, setting up all this issue there. And then joint public and private. This research is another area which we are looking into area that where we can add to this part. Now, another announcement is the regarding the skilling and education. So this is another area which is ease of doing business, etc. I will be talking to these areas specifically now on the issue how we are these get correlated to the India and Australia, and these are the development which have been announced, which we are doing ease of doing the research center and MSME growth. This is the reaching the last mile, and then these are the infrastructure and investment on this point. And this is green growth which we are talking of, and the youth power. These are the few areas which I later on, with reference to India, Australia, have put a separate slide. Now, this is important to understand for all of us. We all know that India and Australia have been trading partners since the beginning of the 18th century. India and Australia enjoy excellent bilateral relations and undergoing positive transformative evolution in region. And currently we are the 17th largest trading partner, and India is Australia's 19th trading largest partner. Now this is number, and these numbers need to improve. And taking into consideration this, there is an economic cooperation and trade agreement which was signed on April 2nd, 2022, and which has been implemented on 29 December 2022. And this will help both countries trade in goods and services to cross $70 billion between India and India. And in terms of this ECTA, India will be provided preferential zero duty market access in Australia for 100% of its tariff lines, covering over 6,000 broad category of Indian product, which will benefit India's labor-intensive sectors such as gem and jewelry, textile, leather, footwear, furniture, agriculture product, etc. And Australia will also be provided. It's a two-way. It is not only one. For 70% of its tariff lines in Indian market, which may include coal, mineral oils, wines, seafoods, etc. And this is expected to robust trade relationship between the two countries and boost bilateral trade from the existing $30 billion to $45 billion in the next 5 years. Further, it is expected to create 10 lakh additional jobs. And particular area of interest will be merchandising, trading, but also in trade services. Australia will be providing Indian services provider market access in what we call approximately 135 sector, would include ITs, ITS, business services, health, education, audiovisual, etc., on this issue. Now, this is the area which agriculture. Now, as I will talking now, how India and Australia can work on the budget, which is specifically area. This is very important, which part is that how India and Australia can work and get benefit of this budget, because this is a particular focus for Australia. As I said, in agriculture, there is an accelerator fund for a young rural entrepreneur to build agri startup. There's a focus on bringing new technology to transfer agriculture practices, increase productivity and profitability. There's a focus on improved quality planting material for high value horticulture crops. Agriculture credit target increase with a focus on animal husbandry, dairy and fisheries. Focus on sustainability in the fishing industries and focus on modernization of agriculture, food processing, and post-harvesting mechanics. Now, what can be done with Australia? Now, Australia has advantages. It has a world-class expertise in agri-services, land, and water resource management. It produces more food and fiber than it can consume, exporting around 72% of the total value of the agriculture, fisheries, and forestry production. Australia is pioneer in development of a drought-resistant crop, robust irrigation systems, and technology that can predict yields and recommend optimal pastures and stocking density. Australian farmers are early adopters of technologies such as precision farming, GPS, and yield predictor that has resulted in productivity increase of gap of 20% over the last 2 years. Australian $57 billion in agri-food export in 21-22. Australia produces enough food to feed 80 million people every year. Global food companies have set up international labs in Australia. For example, American Food and Agriculture Company Allo Life System has set up to use world-leading genome editing technology. Australia-India partnership in sharing agriculture science expertise can be key to improving too. Now, as I was sharing the earlier slide, see India's contribution or agriculture contribution in Indian GDP is just 3.5%. And if India and Australia can come together on agriculture, this can be a win-win situation both for India and Australia, because India is lacking behind in technology, in what we call in new products development, packaging, all those issues. And Australia is, I believe, have the maximum expertise on the agriculture sector. So this budget can give a very big boost to both of India and to Australia, and we can use a lot of expertise of the Australia. And you people sitting in Australia can work on this, work on the people who have the technology, work on the people who can have some ideas, initiative, innovation, and those can be implemented in India. Indian agriculture sector is wide open and people can work on this. Another area which can be of interest is the infrastructure. Now, $9.4 billion is to be invested in 100 critical transport infrastructure projects for first and last mile connectivity of ports, coal, steel, fertilizer, and food grain sectors. Urban infrastructure development to build urban infrastructure in Tier 2 and Tier 3. And there is a proposal to set up 50 additional airports, heliport, water aerodromes, and advanced landing ground, which would have a ripple effect on infrastructures. And then there is a railway capital outlay increase substantially. And now how Australia can help it out. Now, Australia has an advantage of one of the world's most developed logistic network, world-class transport infrastructure with high-end expertise of multinational freight logistics, port logistics, design, and engineering. So I am of the view that this can help a lot because you can propagate this idea that India is looking, and your client, corporates, or other authorities which are having expertise. Now there can be some reach out activities that India is looking to this, and they can have a great business opportunity in India. Similarly, the green growth. Now India is going for a green growth. As I said, Amritkal, the next 25 years, we are looking to green growth. The priority capital investment towards energy transition. The objective is to achieve net zero emissions by 2017. Battery energy storage systems, 500 waste to wealth plants, and then focus outlay on national green hydrogen, lower custom duty on import of capital good for lithium ion battery, higher allocation on scheme for faster adoption and manufacturing, and scrapping old polluted government vehicles. Now these policies are there, and then Australia reduced its emission by 20% between 2005 to 21. It is ranked 6th in the world on renewable energy country attractive index. Australia is the world leader in installed solar. The solar and wind combined share of generated output nearly tripled in the last 5 years. Now, all these expertise of Australia can be advantage to India and a benefit to the Australia. We can come together because ETCA is the best thing which has happened between India and Australia. And both countries are having the best of political relations, economic relations, and no friction and no issue with them. So that's why I will say this is the area we can run. Similarly, in education, if you can look at this, I need not go into looking to the time constraint, I believe. I need not go into this part of this issue. We have announced national digital libraries to be set up, encouraging reading habits, Center of Excellence for Artificial Intelligence, then new nursing colleges, Skill India International Centers, promotion of Center of Excellence, thrust on multidisciplinary courses in medical devices, setting up 100 lab in premier engineering institution for developing application. And now Australia has an advantage. We all know many students go from India for education, and there is no second thought that Australia education is considered to be one of the best in the world, and we can have the best of the advantage. Australia has more than 9,000 agreements and partnership with universities globally, and Australian government funds targeted program to support practical connections between academic research and industry. So look into these areas which India has opened up in this budget and is looking for investment and opportunities. There can always be a reach out activity, a collaboration, working activities, how India and Australia can come together and work out advantage to each others on that point. So friend, these were the areas which I was talking about, that how Indian economy and Australia is going to be opened up. And we are looking for next 25 years at Amrit Kal, that all these areas will be of immense interest to the, I believe, all both India and Australia. And Indian economy, the way I have given you the numbers and figures, we are going to be the third largest economy. And the issue really will be that all we need to is to create an awareness that what India is and what India can do and what India's future is. We're such a mass consumption based economy. It's a any person who can invest in India, it can be a win-win situation for both people. Having talked about this general economic aspect, let me switch over to some taxation aspect. We as chartered accountants may be more eager to know about this taxation impact on that issue. Now, we all know when the budget is presented, the the major interest of people are what has happened on taxation aspect and how it is going to affect me and what I should do and how it is working with this. But one thing which always I wonder, I think you being all Indian chartered accountant having roots in India, we all understand out of this 140 crore people, 1.4 billion people, only 7.5 crore people pay taxes. Still, when the budget is being presented, everyone has an interest in the budget. This is very interesting. And everybody wants to know what finance minister has given me. Sometimes I wonder, you have nothing to do with the tax. What you want? And the job of the finance minister while presenting the budget is very, very difficult and challenging. Everybody wants something out of the budget. Something should be given. Ignoring the fact that budget is at the end of the day is a balancing exercise. Like a trial balance, for every credit there has to be debit. I don't say for every, because normally we say for every debit there is an equal credit. I say reverse, because for every income there has to, for every expenditure, there has to be some income. So if I give concession on one part or I give a relief on one part, I need to find out the resources from the other side. Everybody wants that my salary should go up and increment should be there, but my taxes at the same time should be lower. Now, from where this increment will come, nobody understands. Every sector, health, education will say, people, give me something out of this, give me something more. You have not spent so much. Defense people will say, you are not taking care of defense. Your education will say, you are not taking care of the education. Health people will say, you are not taking education. Health people. And when you increase taxes, people say, oh, why you are increasing taxes? This is there. This is a very, very difficult proposition. So I always say, whenever you are asking for a concession and a relief, always think that at what cost it will come. Somebody will have to pay for it. It can't happen. If my total budget of India has gone up to 46 lakh crore from 37 lakh crore last year, so 9 lakh crore rupees expenditure is supposed to be spent, it has to come from somewhere else. So we have projected that there will be tax collection higher, people will pay more taxes, there will be new avenues, borrowing, all those issues will be there. So that's an interesting aspect. And I always used to wonder in income tax, and normally I say that everybody have an interest in income tax, despite we are having 7 crore taxpayer, which is less than, I will say, 140 crore, less than 5%. And still 95% people who do not pay taxes have interest on that part. And that's why I always say, in India, the income tax was introduced way back in 1861. We are now completing more than 160 years. I believe the interest in this tax has increased drastically. The gentleman who introduced this tax in way back in 1861 never would have dreamed that after 160 years, people will be talking about this tax the way we are talking in this year. Post budget, at least for 1 month, so many seminar program everywhere, electronic media, print media, all things are being discussed. And this reminds me of the old Hindi song, खुदा भी आसमां से जब जमीन पर झांकता होगा, ये इनकम टैक्स किसने बनाया सोचता होगा. That's a wonder. I always say on this part. That's having said, now in income tax, when we look at the implication, and the finance minister, while presenting the budget, if you can just recall back, if you were just watching some when she was presenting budget, because it started at 11 o'clock, which is a good time for Australia at 4:30 p.m. and go to 2 hours to that 6:30 p.m. Now, on that part, the thumping of desk in the parliament was maximum when the people said, when she said, no tax on income up to rupees 7 lakh. That's the most, I think the laudable and attractive term. So meaning thereby, if you have an income up to 7 lakh rupees, then there is no tax. It may be a good news for resident individual only. Fortunately or unfortunately, good or bad, this may not be a good news for non-resident individual. This exemption up to 7 lakh rupees is applicable only to resident individual. And the tax rate which has been announced under the new regime is 3 to 6 lakh 5%, 6 to 9 lakh 10%. The third column, I'm just reading third column, 9 to 12 lakhs 15%, 12 to 15 lakh 20%, and above 50 lakh, above 15 lakh 30%. Now, these new rates give a concession on that part. What she said, then I will not charge tax up to 7 lakh rupees. No, one will be wondering what is this? What does this mean? Because when the tax starts at 3 lakh and 5% is the rate, why 7 lakh tax exemption? Why the 3 lakh should be there? It is very simple. She said the tax rate is there. Your income is chargeable to tax from 3 lakh rupees. But if you have an income up to 7 lakh rupees and you are an individual and a resident of India, I will give you a rebate of 25,000 rupees. So on 7 lakh rupees income, the rebate comes to tax comes to 25,000. 3 to 6, 5%, 15,000 rupees. 6 to 7, 10%, 10,000 rupees, which make 25,000 rupees. So if you have an income up to rupees 7 lakh, then this rebate you get 25,000 rupees, and that's why your tax is nil. But the moment you cross this Lakshman Rekha, you have 7 lakh rupees, 100 rupees, your tax will immediately go up to 26,000 rupees. So by earning 1,000 rupees extra, you can be liable to pay tax of 26,000 rupees. And this phenomena will continue up to 7,29,000 rupees, where your tax liability will be more than the income which you are earning above 7 lakh rupees. So this is applicable only in the case of a resident individual. New slabs are applicable to non-resident individual also, HUF also, association of persons also. So in case you are having income in India, but because you being non-resident, you will not be entitled to this 7 lakh credit benefit. Your income tax rate will be 3 to 6 lakh 5% and 6 to 9 lakh. Now this is the scenario which is there as the tax rates are concerned. And second thing is, now new regime will be a default regime. This is the regime which you have to, which will be applicable to you. But in case a person wants to remain in the old regime, then he has to specifically opt for it. For a salaried employee or a person who does not have a business income or professional income in India, the option available will be to choose every year which is the better. Which one is the better, old and new? I believe you being the non-resident Indian and you being not, I believe you will not be having any business income or professional income in India. So your right to choose the new regime, old regime will be year to year. So what you can do is you can just sit down, compute tax on under both scheme, under old regime and new regime. because under old regime, the exemptions are available, and under new regime, no exemptions are available. So whichever is better, then you can work it out. There is no change in the old regime where the tax will start from 2,50,000 rupees, 250 to 5%, and 5 to 10, 20%, and about 30%. This is the change. Now, if I look at this number, now this is the position which comes out. Now, what will be the comparative analysis of tax saving for resident individual between old and new regime? Now, this gives a picture that if you are under a old and new regime, there is no change if you have an income of 5 lakh rupees under old and new regime both. And this is where this slide shows where you do not have any saving. You don't take a benefit of any ATC or ATD or etc. So if you don't have any saving, this is the slide which will show you under the new regime, you will be benefited by 52,000 rupees in case you don't have any saving, because your liability will be 92,000 for this. So 52,500 under the new regime will not be there. But this is will be for a resident individual. For non-resident, I will come to next slide on this issue. And similarly, if you for 9 lakh, 12 lakh, this will be the now if I look at the deduction which are allowed, these are the deduction which are normally allowed to a person individual. 1,50,000 rupees ATC, which is NST, PF, PPF, etc. 50,000 is National Paving Scheme extra benefit given. Medical insurance roughly 50,000 rupees. Interest on housing loan 2 lakh rupees, and 10,000 rupees is the interest on saving bank. So maximum this is the 4,60,000 rupee deduction which is allowed. But these deductions are also allowed if you have a house rent allowance, you will have a leave travel association, you have an interest on education loan, donation to any temple or trust, or donation to the political party. Now, if I compare this, now this is the situation. As a non-resident, if you are having savings of rupees 2 lakh, saving means ATC or something like this. Now, this will be the position under the old regime and new regime. If you are having saving of 2 lakh rupees and your income is up to 7 lakh rupees, you will be saving the tax under the old regime, because your tax liability under the old regime will be 2,500 and under the new regime will be 10,000 rupees. And then if you have an income of 7 lakh rupees, you will be saving 12,500 rupees. But if your income is 9 lakh rupees, then it will be a new regime despite your saving being 2 lakh rupees. This is the situation which will emerge on this side. But if you have a saving of, say, more than that, this is 3.75 lakh rupees. If you have a saving of 3.75 lakh rupees, then the benefit available to you will be 10,000 rupees more. You have to pay tax under the new regime. You have to go to the old regime. And in case you have a tax of income of 7 lakh rupees and saving of 3.75 lakh rupees, it will be 21,000 benefit under the old regime. And 9 lakh rupees, you will still have the benefit of 27,500. On 12 lakh rupees, it's 12,500. But on 15 lakh rupees, it gets absolutely neutralized. So up to 15 lakh rupees, there can be change between old and new regime. Beyond 15 lakh, I believe the new regime will be much better as compared to the old regime. And then there is an additional benefit in case you switch over to the new regime, because the surcharge, maximum surcharge, which was 37%, has been reduced to 25% in case of income exceeding 5 crore rupees. With the result that a person can save up to 20, 23 and 20, 36, 8 lakh rupees, depending upon the income. This is the max. With the result now in India, the maximum rate, marginal rate, which we call, has come down from 42.7% to 39%. So in India, the tax rate maximum is now 39%. And this is applicable on income exceeding rupees 2 crore. Up to rupees 2 crore, the tax rate will be lower, and this is the rate. Otherwise, there is no change on this issue. Another small concession which has been given is, in order to promote cooperative societies and business in cooperative, particularly in the milk, dairy, and sugar and other agriculture area where many cooperative society can come together. Now the tax rate in case a manufacturing cooperative society is established after 1st April 23 will be just 15%. This is at par with a 15% rate applicable on a company which is in a new company which comes into manufacturing before 31st March 24. So 15% tax rate is the lowest tax rate, and I believe it can be a good advantage for India and Australia on that part, that any company, any entity setting up a business in India for a manufacturing, it pays just 15 or 10% tax in India. After surcharge, it will be 17%. On 83 rupees, it can distribute dividend. And as I will be talking later on a dividend income, the tax rate will be 15% under India-Australia treaty. So that advantage can also be there on that part. So this is another area which we can look into this aspect. So Indian tax rate, I believe now as per individual, corporate, and even cooperative society, because agriculture will be more beneficial in cooperative. So it can be a good proposition for non-resident or foreign citizen also even to look into for making investment here in India, what we call FPI or FDI. It will be a good investment to make in India. And two, because the tax rate will be the minimum, I believe, as I try to compare it, Indian tax rates are one of the lowest in the world. I do agree that there are few countries where the tax rates are still maybe lower than India, but the three factors which need to be taken into consideration for doing business is that there should be a political stability, there should be economic stability, and there should be a good infrastructure. On these three parameters, I believe India is now tough competitor for Western world. Over a period, the geopolitical situation has changed. People are looking, best developed nations are looking not to depend on China as for manufacturing. India is looking to become the manufacturing hub of the world. And that's why I believe these tax rate of 15% on corporate and 15% by and large in treaty, some treaty have 5%, some 10%. This is the most conducive environment for people to shift their manufacturing base in a country which is more reliable, more dependable, more stable, and has the best of infrastructure facility on that aspect. So these, I believe, and individual rates are there. Now, some more changes which may be relevant for NRI perspective is, and you, I think, being an Indian, may be relevant. So we have a provision in India when a gift is made by a person to another person, other than a relative is defined. Now that income, that gift is considered to be income in the hand of the donee. Some issues have arisen in the past that when a gift is made by a resident to a non-resident, how you will tax it, because non-resident is not taxable in India. In order to overcome this, so in 2019, a clause was introduced that any gift made by a resident to a non-resident will be taxable as a deemed income of non-resident in India, and he will have to pay tax according to Indian tax rate. Now, this budget proposes that this clause will also be applicable on resident but not ordinary resident. This was a lacuna because after being a non-resident for 9 years, for next 2 years, a person can be a resident but not ordinary resident. And earlier, we also made an amendment and inserting section 61A, where in particular area, if you have been in India for more than 120 days and your Indian income is more than 15 lakh, you become a resident but not ordinary resident. So in that case, there was an issue whether such gift will be taxable or not. Now the law has been amended to provide, yes, this will be taxable, and resident but not ordinary resident shall be deemed to have income in India and will be required to pay tax in India on this issue. Now, one thing very important is that this gift should be actual money. Property and immovable properties are not covered. And the reasons are obvious. Under the FEMA law, no resident can make a gift to a non-resident otherwise than by way of money. Property cannot be gifted in kind, and immovable property cannot be gifted for way. Inheritance, you can get it. And on share also, there is a ceiling of 50,000 rupees only under the FEMA law. So look into that aspect. The law says only sum of money, which is the actual money which have been given, otherwise cannot be given. Now, there is another issue which has come up now. See, in India, in order to avoid tax evasion, in order to address the issue of tax evasion, an amendment was made way back in 2012, when the company issues share, the share should be issued at a fair market value. If you issue share at a value which is higher than the fair market value, then the difference between the value at which you have issued and the fair market value is treated to be your income. Now, and this is was because I believe the hawala money and black money was being brought into the company by way of charging higher premium, etc. This section was applicable to only resident, and this is called an angel tax probably. This section was not applicable to non-resident. In case a company issues share to a non-resident, then this was not applicable. And the idea was probably with the objective that government was interested in getting more and more funding, etc., from non-resident. It doesn't matter what the money coming in. But look into the now leakage of tax and look into the issue which the government may have faced. Now it is being said that even when the company issues share to a non-resident, then the value at which it is issued is more than the fair market value, then the difference will be liable to tax in the hands of the company, not the person who is subscribing. Now, in case you are intending to put money in the company, any Indian company, other than a listed company, then you need to be careful, because after having invested, even if the tax comes on the company, it is your investment which will get eroded. So you need to be a little bit careful while subscribing to the share capital of a company other than a listed company in India, and the price share value cannot be more than the fair market value. And here there is a challenge. Under the FEMA law, the share value cannot be less than the fair market value. And under income tax, it cannot be more than the fair market value. And fair market value is not a such thing which can be hard, very, very hard and fast can be determined. In the income tax, we have allowed three methods. One is net asset value method, one is discounted cash flow method, and third, we give you any other method by which you can convince the assessing officer or satisfy the assessing officer. But I believe all are subjective. It is not so much objective. NAV I can understand is objective, but discounted cash flow and other method will be subjective. So will be the FEMA. So this will be a big challenge. And I am of the view, frankly, this amendment, though look to be a anti-tax avoidance measure, but probably it does not help the economy. It does not help the investment in India. As I was looking to the figures of total FDI investment coming in the year 2022, it has gone down to $54 billion as against $77 billion earlier. India is still interested in getting more and more investment in India. I believe these type of restriction can be a dampener, because when you want to allot share and want to further issue your company, it's a negotiated price which the share at the value is issued, and which need not necessarily be a method value which you can compute by applying one of these methods. There can be so many parameter discussion, what you will bring, how you will bring, and how the business will grow. If I am doing, and I commonly give an example, if a person is doing a small business and he has some potential, but because of the fund, he is not able to do it, and he is able to grow up. Now, to prove on paper may be very difficult, and this will increase some litigation. But anyhow, this amendment has been made. Just this is one may be relevant for your own purposes also. Now, there is another amendment for a startup. Now, startup, for you know that a startup income is exempt for 3 years out of the 10 years after it has been incorporated. There was a condition that this startup should have come into existence before 1st April 23. Now this period has been extended, that this benefit will be available to the startup which has come, which has been incorporated before 1st April 24. So there's another 1 year has been given, and then small changes about the carry forward of losses, etc., for a period of 10 years, which is, I don't think it technically maybe you may be interested in knowing. But one thing very positive is that since Government of India is encouraging startup, and if you have any idea, or if your associate or any person in Australia has any idea of innovation, etc., I want to that, this will be the best opportunity to set up a startup in India and claim all the benefit which the Government of India is giving on that aspect also. Now, another area of interest may be winning online, because online gaming can be anywhere. And if you are having some online gaming in India, so there was an issue at what rate the tax will be there. So now law has been clarified, the tax rate applicable on online winning will be on net winning at 30%. And how this net winning will be computed, some rules will be notified later on. So the rate, if you are playing this online games and if you win something from India, then it will be a 30% tax straight away. And there will be TDS, tax withholding tax, similarly on 30% on that aspect. Now, another area is that some market linked debenture are being issued by the Indian, I think, various funds and authorities, etc. These, though, look to be a debt instrument, but these are probably a derivative like or equity link, because the return of interest, which they say interest, is not a fixed interest, but they say this is linked to some index. So they may say that in case the index goes up 5%, then you will be entitled to interest of 5% and 6%. So there is a thought process that these are though called debenture, but these are really equity, because what you are getting is not a fixed interest, you are getting a flexible interest, which is linked to the market, and that is a market. So they are on that way, there was a concession available to it. Now this budget clarifies that this will be considered as a debt instrument, and whatever the money value difference you are getting, that will be taxed at a normal rate, and that will be a short-term capital gain and will not be eligible for a concessional rate. Now, something I can talk about is only 1 hour. So just for 15 minutes, I can spend on this India-Australia treaty and how we can work it out on this issue. We all know that India, Australia have a double taxation avoidance agreement. And there are 3 major areas which can be of concern, which can be beneficial. One is the dividend income, another is the interest income, and another is the alienation of property, that is called capital gain. Now, India duty treaty, as per the treaty, dividend paid by a company which is a resident of the contracting state for the purpose of tax being dividend to which the resident of the country is beneficial may meet tax in that. Now, this is an enabling provision. Normally, the DTAA say a resident can be taxed only in the country of which he is the resident. But DTAA provides some exception that a resident can be taxed in other countries. Now, if you are a resident of Australia, and normally your income should be taxed in Australia only. Now, if you earn income from India, so DTAA provide which income can be taxed. So if you are getting a dividend from a company which is a resident of India, then that dividend is chargeable to tax in India also. India can also do. That's why I say can be maybe taxed in the other state, means in India that way. Such dividend may also be taxed in the contracting state, but the tax so charged shall not exceed 15%. So this is a concessional rate of 15%. Under the Indian tax law, the tax rate is 20% on dividend income in the hand of a non-resident. But India-Australia treaty has a tax rate of 15%. So this is an advantage of 15% of the. When I was talking about this earlier about the Indian corporate tax rate, as I said, the Indian corporate tax is 15%, and after surcharge come to 17%. And treaty rate on dividend is 15%. So if any person who makes an investment in India and carry on business and manufacturing company, if it earns 100 rupees, 17 rupees it will pay to the government of India, and 83 rupees it will be having income. Out of 83 rupees, it declared a dividend of 15%, and this is on, I believe, 72 rupees. On 72 rupees, if you pay 15% dividend, which will come to somewhere 10 rupees. So if you pay dividend of 10 rupees, on that 10 rupees, 10 rupees, if you pick, declare a dividend of 72 rupees, you will be required to pay a tax of 15%, which will be 10 rupees. And you will be, that means Indian effective tax rate will be 28%, with a full credit available in Australia of the on 10 rupees, because a dividend tax paid in India now will be eligible for tax credit in Australia. So this is, I believe, is the tax, which is the minimum tax. And if you don't declare any dividend and you continue to hold the money in India, then it is 83 rupees within your company, and the way it is. Neither it will be chargeable to tax in India, neither in Australia. So this is the big advantage, I believe, say on that basis, which India-Australia treaty provide for a non-resident, and it applies for Indian investment to Australia also. It is not only that Australian investment in India, it provides for, and in treaty rate, there is no surcharge applicable. So overall tax rate is 15% on that part. So dividend from mutual fund is also considered to be the same nature as is the dividend on the share. So on such part on this is same. Now another area is of interest. Now under Article 11 of DTAA, between India and Australia, interest arising in one of the contracting state being interest to which a resident of the other contracting state may be taxed in other state, such interest shall not be 15%. So again, interest rate is also 15% in India, Australia. If you have made an investment in India like debenture, etc., and if you are earning any interest, then your tax rate is again a 15%, which is a concessional rate, and you will get a full credit of that on that part also. And under the Indian tax law, there is a TDS provision on some of the investment where the tax withholding is 5%. So this is again a concessional rate available. Otherwise, the normal rate would have been, as I said, in the personal case, 39% or another case. But this is 15% interest tax rate on dividend interest is a win-win situation for that purpose. And the third area is the capital gain, which I can talk about. Now, income or gain derived from the alienation of a shares or a comparable interest of the company, the asset of which consists wholly or principally of real property, is to be taxed in the country where the property is situated. If you have a company in India and that company has a what we call a real estate, main property is real estate in India, then India will be taxed. But if that company has a real estate in Australia only, then Australia will be taxed on that. So there is a possibility that there may be a company in India, but holding a property in Australia, then Australia will get a right to tax that company. Now, in other cases, the right to tax on transfer of share will be with the country where the company is a resident on that part. So this is another area which can be worked out to advantage on that part. Friend, in addition there are some other changes which may be of interest, but I will just run through to just make you aware of this. Then we can have some other discussion on that part. So we all know that oil drilling, etc., businesses start to tax at a very concessional rate in India, 44 BB and 44 BBB, where we are charged 10% of the total amount received is considered to be income. So now that being said, the benefit of depreciation either will not be available. Your gross receipt will be considered to be 10% as your income. I believe Australia also has expertise on this oil drilling, etc. So that can be also be an advantage on this part also. Another area, you being a non-resident Indian and you may be having interest at buying property in India sometime. And as a old CA student of income tax, you may be aware, under capital gain, India gives a concession. When you sell a residential house or buy a new residential house, that capital gain is exempt. Similarly, when you don't hold more than one house and you sell some other investment, but then you invest that money in buying a new house, that income is capital gain is also exempt. Now, in order to limit this benefit only to those people, not to allow to for higher net worth, they say that this benefit will be available in up to the value of rupees 10 crores of the new residential property. So if you have sold a property of 2 crore rupees for 15 crore and you have bought a property of say 20 crore rupees or 15 crore rupees, then the benefit will be restricted to 10 crore rupees only. It will be considered that you have bought a property of rupees 10 crore only, and whatever the proportionate benefit comes, that benefit will be available, both under section 54 and 54F. So the new residential house value is to be restricted to 10. It is not that only 15 crore rupees. It is not that eligibility is up to 10 will be there. You can buy a house of 20 crore, 30 crore, 40 crore. You will be eligible, but the benefit will be restricted considering that the new property value is 10 crore rupees. Now, this is the India's Gujarat International Financial Center. As you know, we have set up a gift city just to talk about it long time. This was Honorable Prime Minister dream project when he was the Chief Minister of Goa. And now we are India is promoting that gift city like anything. It has the best of the infrastructure. It is just like absolutely away from India. Everything is, it is just like considered to be a foreign country. And this gives a lot of opportunity for making investment and doing business. And this is a project which is, I believe, a dream project of the Honorable Prime Minister. And India has potential to access a large financial service opportunity. and this is working. And a strategic investment and ability, security of investment, high returns, capital investment, appreciation, pride of ownership, and for no tax for non-resident on all. There are a lot of offshore banking activity which has come up, and every budget gives one concession or the other concession. Even for transfer of one unit to another unit, all from one place to another place, this income is totally exempt on this part. Now, one other area is SEZ. If you are operating in SEZ, now a new condition has been imposed that export from the SEZ, you have to bring the export proceed within a month of 6 months from the end of the year. And in case they get delayed, then you have to have an extension from the RBI. Otherwise, the tax benefit may get lost on this part. This is about residential status. I think I can skip it out on the, about a treaty, how the residential status can be determined. In India, we follow 182 days, and another is resident but not ordinary resident. Then we follow 120 days if your income in India is more than 15 lakh rupees. Under the Australia law, there are, I believe, 3 I have tried to capture. These are the 4 tests which are applied: a residue test, a resides test, domicile test, and 183 tests. So these are the tests. I'm just leaving it to you because looking to the issue, we can talk about on this issue. This is a determination of the status. And in case of a conflict, then this is a tiebreaker rule which is applied, where you have a permanent home, where your personal and economic relations are there, where your habitual abode is there, of which country you are the nationality, and then even still the tie remains, then of course to apply to the competent authority to decide the tiebreaker rule who will be the resident. These are a few judgments on that part. We can skip it out, that in case any problem comes up, how to tiebreaker rule will be applicable and what will be taken into consideration on that part. There are few other changes. I've just run through a smaller changes just to apprise you of what is happening in India. Now, as you know, insurance, when you buy an insurance policy, you contribute amount. There is an exemption of the investment you make in the insurance, 1,50,000, which is there. But at the same time, there is another concession. Whatever you receive at the time of maturity of the policy, that is fully exempt. So if you buy a policy where you are paying premium of 10 lakh rupees per year, and you are a policy of say 12 years and you receive 5 crore rupees at maturity, the full amount was income. Now, in order to restrict this benefit for a high net worth individual, and not to allow the insurance policy to be used as an investment tool rather than a insurance cover, the law has been amended to provide that exemption will be available in respect of the maturity amount in respect of policies issued on or after 1st April 2023, when the premium in any of the previous year has not exceeded 5 lakh. So you cannot buy an insurance policy after 1st April 2023 where the premium is more than 5 lakh rupees per year, or aggregate of the premium is more than 5 lakh rupees. So after 1st April 2023, in case you want an exemption, then your exemption will be limited to those policies where the premium was less than 5 lakh rupees in aggregate. But this will not apply to earlier policies issued. This is a small change. Another change which may be interesting, just to give you an idea how Indian tax has become easier. This is a small amendment which has been made in presumptive taxation, where up to 2 crore rupees there was a presumption that 6% will be considered as income. Now this threshold has been increased to rupees 3 crore, with the result now, in case you have a turnover of 3 crore rupees and your turnover of 3 crore rupees, cash turnover is not more than 5% of the 3 crore rupees, 6% will be considered to be the income. Now, if 6% is to be considered the income, then the total tax payable will be 18 lakh rupees on 3 crore rupees. I can just take off this presentation, I think now, and then I can talk just. Now on 3 crore rupees of turnover, 6% is the income, 18 lakh rupees. On 18 lakh rupees, the total tax is 3 lakh rupees, or 2,40,000 rupees. Sorry. Just imagine a person having a turnover of 1 lakh rupees per day. A kirana shop or a book shop or a hotel or a restaurant, 1 lakh rupees is a reasonably good amount, I believe. 1 lakh rupees per day. Because 365 days, 52 Sundays and other holidays, if I count it, and tax liability just like 2,40,000 rupees. No accountant required. Even if you pay the salary of accountant, it will be more than 20,000 rupees per month because your tax liability is 20,000 rupees only. No tax audit, no audit required. Free for all. In India, I believe that's a big concession. You have a turnover 1 lakh rupees per day. And I believe in India, other than tier 1 and tier 2 cities, I don't think many shops will be having turnover more than 1 lakh rupees per day. And just paying tax of 2,40,000 rupees, no law, nothing doing, no books of account, no chartered accountant required. That's a phenomenon on that part. That's a big concession. I believe ease of doing business, when we talk about ease of doing business, how India has improved on working it out. And as I said in the beginning, and I will say on that part also, see the way Indian economy is doing, the way infrastructure is developing, the way economic laws are being tweaked in, and the way the tax laws have been implemented, particularly GST and the income tax both. Now, GST gives you a very smooth working from one state to another, free movement. There is no issue, no cascading effect. And with income tax on manufacturing at 15%, I am of the view that India is one of the best destinations. And sometimes people ask this question, whether we should take the risk of investing in India. I pose a counter question. Whether you can afford to take the risk of not investing in India. India is such a big country, a mass consumption based country. When we opened our economy way back in 1980, and we allowed colored TV to be imported, not a color TV set was available off the shelf right from Tokyo to London. Just look at the mobile phone in penetrations. A population of 140 crore and mobile phone connection 170 crore. Which country can have this type of consumption? And a country with $1.4 billion or 1.4 billion population with a per capita of just $2,200, which is likely to go to 4,500. What is the exponential growth and the demand likely to grow? And the tax which you are paying is the minimal tax which you are paying at 15%, 70%. This and best of political stability, best of economic regulators, RBI, SEBI, etc. The money is absolutely safe. India is only country that post 1960, not a single bank has faced a problem. Not a single depositor has lost the money, a single rupee. All people have, because the RBI has been proactive. Wherever there was a weakness in any bank, it was got merged, making sure at the term of the merger, the depositor get the full amount. Best of Singapore also had a problem later on, I think 10 years back when Habib something back was there working, there some issues have come up. But India has been one of the best in. We have a SEBI with the insurance regulator or RBI, all regulators working it out, capital market, etc. And all other issues are there. Taxation continues to be an issue, I believe, litigation, but still there are ways and means which have been worked out, advanced pricing agreement, etc., etc. And this budget, I believe, is a budget, as I said in the beginning, of next 25 years, defining the not the destiny, what we call the destiny of the India only, looking to the global economy, a destiny of the global economy. Because as we said, in 2023-24, the IMF and the World Bank is projecting that the best of the economy may go into recession. It is India's economy which is going giving the number to the IMF and the World Bank, so that overall number of the global economy still continues to be better as compared to what would have been better. That's the scenario which I believe. With this, I think I can just put a halt on this issue, and time permitting and whatever, of course, Anandji and others, you can take call. If you can have few questions, answer whatever issue on that part.
Yes, thank you, sir. So we have 3 questions on the chat box here. So first question is from Rohit Gadgil. Is there any plan to improve India's indirect tax income collection instead on direct taxes, similar to currently happening in developed countries like Australia, US, or any insight onto this?
I believe the way GST collections have improved in the last year post-COVID. See, we implemented GST in 2017, 1st July 2017. We completed 5 years in 2022. And we all know that transition is always difficult. And as we were coming out of the transition, we had faced a problem of this pandemic, COVID, and now 22 onward, pandemic is over. So collections are improving, enforcement mechanism has improved. Wherever the teething problem was there, that has been erased out. And I am reasonably sure that not the indirect tax collections are bound to increase, because with the, as I said, as you earn more, you spend more. And the new tax regime, which is where deduction less, is an idea to increase collection of indirect taxes, giving more money in the hands of individual, not expecting that person to invest. I can just give an example. Now, with an income of 10 lakh rupees, the tax under the new law is 52,500 without any investment. Earlier, this person was, after 10 lakh rupees, was making investment of 4 lakh rupees. The 6 lakh rupees was the only fund available for him. Now with 52,000 rupees, no investment, the fund available will be 9,50,000 rupees. And there are 5 crore taxpayer in India which fall in this bracket. And if I assume even 1 crore taxpayer don't make an investment and use this money, 4 lakh crore rupees will be the extra money which will be coming every year in the market. And that you can imagine how much growth it will give to the indirect taxes. I hope, yes, India is looking, and that's the right thing, because developed nations have a higher ratio of indirect taxes on that part. No issue there.
Thank you, sir. So there is another question from Sundar as with reference to a section 56.2.7b, it seems to be more to protect the rights of the investor, including non-resident investors, as they can now insist the shares should be only issued to them at FMB and not at a bulleted valuation. I think it's a reference to the FMB where.
I know. Sundarji, I think it's it's an idea to how you look at the same issue. If the picture is there, see, the idea is that I do agree that one way can be that you cannot fleece the non-resident by putting a value much there, the fair market value is to justify. But from the taxation perspective, I am of the view that it's a commercial decision between the investor and the investee. And tax people should not come in the way, in the sense that they should not say, no, we will tax it that way. I do agree this can work as a good regulator and good safety mechanism for the non-resident investment. There cannot be second thought about that.
Thank you. Thank you, Wilsonji. There's the next question from Amlesh Maskikar. So the 5% DTAA concession on Indian dividend, interest or capital gain is not saving on an overall basis, because the same income will be taxed in Australia, though with an Indian tax credit. So NRIs pay the income tax in Australia per Australian tax rate anyway. So this, I think this is more of an observation.
I know, I agree, fully agree. There's no second thought about this. Yes, it is can be there on that part only. So no second thought. You are absolutely right. If you are a resident of Australia, you will get a credit, and whatever is the tax rate applicable in Australia, you will have to pay tax rate.
Thank you. And we have a last question from Suryakant Jain. Just a very nice presentation. Just to clear my understanding, as you mentioned, India has low tax, but as we have to declare global income here and will be taxed at higher rate, so will there be any benefit as we have to offset low tax rate paid in India and pay higher tax rate here on global taxing? I think this is a similar question in the same line.
Oh, I know. You see, Australia, being a resident of Australia, you're liable to pay tax on global income. So whatever Indian income you earn, that has to be, you being a resident of Australia, you have to club it and pay tax and take a credit on this part. But if I look at a corporate tax structure and a corporate tax structure, it need not, because in case you have a company in India, then you are not liable to pay tax in Australia on the income of the company. Your wealth is growing and wealth is rising. And that way, whatever your value of the share is going up and your money available in India is going up. So long you don't declare dividend, then that income may not be chargeable to tax on that part. So I believe that's the way the global company and all corporates operate, and the same thing will apply here on that part also. So you can have a structure where you can have a corporate just to plan it out, where you may not be required to pay the tax as you earn in Australia on that income.
Thank you, sir. So any other questions, guys, please put up on the question and answer session. We have
Anandji, we can take an open, I think if there's, it's a webinar or we cannot have the people, no? The mic.
No, we can't have it. But if somebody wants to raise a hand, I can, allow them to speak on that one. So, Samir. Yes, Samir.
Yes. Thanks, Anandji. And Sir Vedji, really interesting presentation. I had one personal question. Looking at the macroeconomic, environment between India and Australia and the recent agreement, the economic cooperation and trade agreement, I feel the bilateral relationships will only keep on growing compared to the current state. And I fully agree that there is probably no other better way avenue for investment, perhaps apart from India. But we as chartered accountants sitting in Australia, how do you envisage our role in terms of facilitating and increasing this whole process, given the fact that we are still only scratching the surface between the two countries?
See, I would say that I consider my fellow chartered accountant sitting in Australia are the best ambassador for India. You see, we have a diplomat sitting in Sydney and Melbourne, and they are work, I believe, only in an official status, protocol, meeting people, no doubt, talking, interacting. But we professionals have a direct connect and knows in and outs of the Australian businesses. Probably the knowledge and expertise and the reach out we chartered accountant have, I believe no one will be having of the Australian businesses, because we are all working for Australian businesses there. And in that scenario, if we have I think our background of India's infrastructure, India's working, etc. For us, it is very easy to reach out and to talk to the management, etc. What type of opportunities are available in India, which people can talk about it on this issue. You can think it about. Say somebody is working in particular agriculture sector, because India, I believe in Australia, there are corporates which are looking at seeds or otherwise. And then you believe, yes, in India also there is some situation and you can talk to them that India can be this way and can help out. And first you have knowledge of India and Australia both, and then you know what India is doing. At the same time, for you, it is very easy to connect that corporate with the Indian consultant or Indian authorities, etc. It is easy for you also. Similarly, if on the other side, when you are in connect with Indian people also, and you know what are the opportunity in Australia. So somebody is putting a coal plant or ore or mining or something like this, and you know that here there is a person who is looking for a partner or investor, and this is a good project. And you can talk to some people in India because you have a reach out to India, your friend, are also chartered accountant. They are in some corporate sector touch out. So it is so that's why I say, frankly speaking, if you can just look at one of the presentation which I gave for the students, what we call motivational talk for the students, ICAI student, I still consider chartered accountant qualification and the later on working is one of the best in the society. We know absolutely deep insights of the society, business, government, corporate, everything, which other person cannot. We know the accounts. And if the accounts on table, as I say, as a CA student, we know which director has gone to which hotel, where he has eaten food, where he has taken a room, how much is the room rent, where he has spent on advertisement, what is his personal expenditure, this purchase is being made at what rate, being sold at what rate, what is the difference, why this, who is making money, from where the money is coming out, where the money is going out. We all know inside, and this is our knowledge and expertise which we get by way of our profession only. And knowing fully well, if we find a person is looking for investment and India there is a person who can invest, you can say it is a golden opportunity, come and invest. This is the area you can talk to. We can talk to India. It can work both ways. So I always call that Indian chartered accountants settled abroad are the best, they're better than the diplomats. And I believe Melbourne chapter can organize a talk with the corporates, call some corporate heads also for interaction on a tea or some lunch or dinner, have an interaction just for it can be win-win situation for both sides, for employment also, for ideas also, for investments also. Everything can be there. And touch wood, our profession's credibility, both Indian chartered accountant and Australian chartered accountant, I believe in society we are taken seriously. The corporate houses will like to interact and work on that issue. So if we reach out and bring them, those people, CEO, CFO to our program, so there can be increased interaction and can help developing business and increasing business. And you never know opportunity when the opportunity may come knocking at your door.
Yes, sir.
Totally agree. Thank you, sir.
Thank you. So we have two more questions. First question is from Pankaj Damle. Thanks for the information presented, Vedji. Can I have a quick input on what the government is doing to improve the judiciary and reduce the litigation workload with respect to the taxation matter?
This is a very larger question. I do agree. I will not say that we have the best of the judiciary to reduce the litigation of taxation, particularly aspect. There are challenges which are coming up. Though government tried its best to come Vivad Se Vishwas scheme to settling the dispute, though we have advanced pricing agreement, we have a dispute resolution panel. But I do agree that litigation on taxation aspect is not diluted to that extent which should have been. But I will say yes, efforts are on and challenges are there on that part. I must confess on that part.
Thank you, sir. And the last question from Dimple Kumatalwa. For indexing long-term capital gain, tax on inherited property, if the property is acquired before 2001 but property gifted in 2004, which year we can use?
See, the law is very clear, Rimpalji. When a property is gifted, it is considered to be acquired by the donee when the donor has acquired. It's a pass-through property. If say you have inherited or gifted. So if I have received a property from my father who has acquired the property way in 1976, or my brother has gifted a property which he has acquired in 1981 or 84, and gifted to me in 2008, 7, 8, whatever may be the situations. So it will relate back to the year when he has acquired. That's a phenomena. So in your case, it will be considered to be when the previous owner was acquired. But in addition thereto, a law has been further amended that now if a property which you have sold is of a period before 2001, you can work out the fair market value on 2001. And based on that fair market value, then you can take the indexation benefit from 2001 to 2023. So in case you have received a gifted property, say in 2004, and which was purchased in 1984, so you will find out the value of that fair market on 2001. And then from 2001, you can have an indexation also.
Thank you, Vedji. I think that's all.
There is something in chat box also, I believe. Oh, sorry, you have put it all right.
I just put it out for somebody to ask question. We just wait for a minute if somebody have any other questions. Otherwise, we can conclude the process. I believe there is no question further. Thank you, Vedji, and I would like Sami to start with the book. Thanks.
Thank you, Anandji. Vedji, we are extremely delighted and very, very honored to hear your analysis of the budget. We are really, really lucky to hear from you. When I was going through, your analysis, I found your whole commentary very insightful, at times very humorous, very detailed, relevant, and very timely analysis. And at times also find it very, very that you were very honest in your comments as well. That there are certain sections we still have to improve on, and so on. And very, very broadly, we did touch upon. You did speak about, Melbourne, you visited your trip in 2019, cricket, tennis, and the weather. We also touched based on, the Amrit Kal of the budget, the planning for the next 25 years, the stock market cheering the budget, and the focus on growth and welfare. We talked about India's GDP rate, 7%, being the fastest growing economy, for very high foreign reserves, inflation rate, just CPIs and so on. India's GDP overtaking in another 4-5 years, it will be number 3 spot in the world. We did also talk about the budget's focus on health, research, upskilling, and education. And one of the interesting areas I found was, investments in agri startups, infrastructure, green growth, education. Probably these are the areas where we, as Australians and Indians, can collaborate together. I find your comment of saying that yes, Indian CAs are the ambassadors and they can work on both sides of the equation. Very interesting. We also talked about the double taxation treaty and the dividend taxation rate being concessional rates of 15%, and the gifts to our NORs and so on. We also talked about the angel tax and the winnings on online gaming. So at the end, I would like to propose a vote, a thanks on behalf of the Melbourne chapter of ICAI, and also all the members who have attended today on a Saturday evening and you on a Saturday afternoon there. We really appreciate your time, sir, because you have given us so much food for thought for the next year, or may possibly another 25 years in time. But thank you so much for that. And we hope that you have more opportunities to visit Australia. And hopefully we will be more than happy to play host for another time. And hopefully we can meet again in person when that time occurs. So thank you very much, sir. I would also like to thank the Melbourne chapter and the managing committee for hosting such a wonderful and insightful webinar. Thank you.
Thank you, Samirji. Thanks as a player and as a player to be in Melbourne. And thanks to Harshvardhanji in the absentia is not able to join. I believe that's it. Thank you, sir.
Yes.
Thank you.
Thank you very much. Thank you, members.
Thank you.
Harshaji, back to you.
Yeah, thanks. So with this, we end this session. Okay, thank you.